Thank you for joining us for this month's National Economic Outlook, written by Local Market Monitors founder Ingo Windsor. Ingo is a graduate of MIT and Boston University, and he's not your typical economist. He has a knack for presenting complex facts in an easily understandable way. So without further ado, I'll turn it over to Ingo.
Thank you very much, Julie. Every month, we look at the latest available data to see what they can tell us about the economy and about real estate markets, where they are now and where they may be headed. You make better investments when you have a better idea of the forces that affect supply and demand. This month, in addition to our usual review of the job situation, we'll also speculate a bit about what a longer period of low economic growth might look like. I think the best way to see how the economy is doing is to see how well it's creating jobs. Jobs mean consumers, and consumers are the U.S. economy, at least for now. You can see the increase in jobs every month compared to the same month of the previous year. And it's a disturbing picture. Not only is job growth low, it seems to be slowing at an accelerating pace that will soon put us into negative territory. One reason, of course, is the deliberate elimination of jobs in the federal government, where there are now 250,000 fewer jobs than there were a year ago. That's almost 10% of the workforce. It may be that this process is now complete, that there won't be more huge cuts, and that there may even be some rehiring in future months. But that won't be much help for the economy, because it's not just federal government jobs that have been lost. Jobs have been lost in state government as well. And they continue to disappear in the manufacturing sector. Growth has come to a halt in the construction sector, especially in home construction. Job growth is zero in retail. And jobs continue to disappear in the very large business services sector. There's slow but slowing job growth in finance. Restaurants are having a small rebound. But even the large healthcare sector is growing at a slower pace. This sector has been carrying the economy for the past few years. It's the only reason total job growth now is still positive. What these numbers suggest to me is that the shedding of government jobs is just accelerating a process that's been going on for a while that would bring job growth to a low level in any case. It's a long-term trend towards slower economic growth that's in tune with the slower growth of the US population. Europe, Japan, and even China are in much the same situation with an aging population. But until now, the US has made up for slower growth by welcoming immigrants. This chart shows the natural growth of the population in purple, which has been slowing for years, and that immigration in green has made up the difference. The natural rate might again increase in the coming years, but we can be certain that immigration will be a lot lower. That means job growth almost certainly will be very low for an extended period. What will that mean for the economy? Maybe nothing. After all, other measures of economic health paint a much rosier picture. Gross national product was trumpeted as growing at a 4% rate in the third quarter, and the stock market is at all-time highs. But I'm less optimistic. The US economy is a consumer economy built on constant growth in demand. Where will that extra demand come from if there aren't more jobs? Maybe wealthy people will spend more. Maybe the US will again be a powerhouse exporter. Maybe lower prices will make all consumers richer. These things could happen, but I'm certain that none of them can happen in the next few years. Economies can change over time, but not overnight. In that case, what does the near-term future look like? I think it has a lot to do with debt. Consumer debt is the element that's missing in calculations of gross domestic product and the stock market. It's the amount of debt consumers have taken on in order to keep spending when their incomes are squeezed. Here we see it as dollars per person adjusted for inflation, and this amount does not include mortgages. It was at a record level before the 2008 recession and is even higher now, but the level matters less than the shape of the curve. During the past 50 years, every pullback in debt has been associated with a recession. Because it seems that consumers have maxed out their borrowing now, I think we're already in a period where slower demand will force the readjustment of overpriced assets. That includes stocks and homes, and finally gets us back to real estate markets. Home values are just beginning to fall in Florida, and it's my guess that we'll see this behavior spread across the country, not dramatically, but for years. That's it. In this time of uncertainty, it's important for bankers and investors to stay on top of local economic and real estate developments. Local Market Monitor provides the data and analysis they need with local market reports and investors' metro analysis. Thanks very much for following along. This is our National Economic Outlook. I'm Ingo Windsor.